Are you tired of losing trades and constantly second-guessing your entries? What if I told you there's a trading indicator that can give you sniper-like precision with tight stop losses and incredible accuracy? But here's the truth. Indicators alone aren't enough. We all know they're lagging, and relying on them without confirmation is like trying to win a battle with half the tools you need. That's why in this video, I'm not just introducing you to an indicator. I'm giving you the complete strategy. A powerful indicator combined with my proven price action techniques to eliminate the lag and take your trading to the next level. Whether you trade Forex, crypto, indices, or stocks, this setup is versatile and works across all markets. If you're ready to take control of your trading and achieve consistent results, this is the video for you. First, let's add the indicator to the chart. Open TradingView, search for Signs of the Time by Luke F., and we'll adjust the settings to fit our strategy. Don't worry, it's straightforward and easy to follow. Let's get started. Alright, let's break this down step by step. This indicator is built on moving averages, and to get the most out of it, you'll want to ensure your settings match exactly what you see here on the screen. Once that's set, we can move on to the sell setup. This is where the strategy comes to life. For a sell setup, there are two critical components. 1. Price must trade above the previous swing high of the moving average. This indicates the market is overextended and could be due for a pullback or reversal. 2. Next, we wait for a rejection candlestick pattern. This is our confirmation signal. Here's what to watch for. The first candle should be a bullish candle, showing upward momentum. The following candle must be a bearish candle, showing downward momentum. And importantly, the high of the bearish candle should be higher than the high of the bullish candle. This creates a rejection or doji-like pattern, signaling that buyers are losing strength and sellers are stepping in. Now, let's talk about the bullish setup. 1. Price must trade below the previous swing low of the moving average. This suggests the market is oversold and could be ready for a bounce. 2. Again, we wait for the rejection candlestick pattern to confirm our entry. Here's how it works for a bullish setup. The first candle should be a bearish candle, showing downward momentum. The next candle must be a bullish candle, showing upward momentum. And the low of the bullish candle should be lower than the low of the bearish candle. This creates the same rejection pattern, but in this case, it signals that sellers are losing control and buyers are taking over. Why is this confirmation so important? Relying solely on indicators without confirmation is a recipe for inconsistency. Indicators are lagging by nature, and without price action to validate the signal, you're essentially trading blind. By combining the moving average indicator with price action confirmation, we ensure our trades are backed by real market behavior, not just delayed signals. This approach is what separates consistent traders from those who struggle to find an edge. To summarize, use the moving averages to identify overextended market conditions. Wait for the rejection candlestick pattern to confirm your entry. Always prioritize price action. It's the foundation of any reliable trading strategy. Now that we've covered the setup, let's move to the charts and see how this plays out in real time. Now, let's walk through our first example, which is on the 15-minute time frame. Keep in mind, this strategy works on all time frames. Whether you're a scalper, day trader, or swing trader, you're fully covered. On the chart, we can clearly see that price is oversold, indicated by the fact that it's trading below the zero line. The next step is to confirm whether price has traded below the previous swing low of the oversold level on the moving average. As you can see here, that condition is met. Now, we look for our confirmation signal, a doji candle or a rejection candlestick pattern. In this case, we can see that pattern forming right here. This is our green light to consider an entry. Once the rejection candle is confirmed, we enter the trade, placing our stop loss just below the low of the rejection candle. For our take profit, we target the previous swing levels. In this example, we can set our take profit at the nearest previous support level, which aligns perfectly with the strategy. This approach ensures we're trading with precision, using both the indicator and price action to confirm our entries and exits. Let's move on to the next example to see how this plays out in another scenario. Moving on to our second example, this time focusing on gold on the 5-minute time frame. This setup is perfect for traders who prefer scalping strategies and want to capitalize on quick, high-probability moves. On the chart, we can observe three key things. Price is below the zero line, indicating an oversold condition. The indicator shows that price is trading below the 5 low of the oversold areas, reinforcing the idea that the market is extended and may be due for a reversal. Most importantly, we can see that price is creating a fake out of the previous support level. This means price briefly broke below support but failed to hold, signaling weakness in the downward momentum and a potential reversal opportunity. Once these conditions are met, we wait for our confirmation candle, the rejection or doji pattern that signals a potential reversal. In this case, we can clearly spot that candle here. With the rejection candle in place, we enter the trade, placing our stop loss just below the low of the rejection candle. Because we have a fake out scenario, our take profit target will be set at the previous swing high, which aligns with the natural resistance level and provides a clear exit point. This example demonstrates how the strategy can be applied to scalping, using precise entries and exits to maximize efficiency in fast-moving markets. Let's continue to the next example to further solidify this approach. For our third example, let's analyze a scenario where price is signaling a potential bearish reversal. On the chart, we can see that price has traded above the zero line, indicating an overbought condition. This suggests that the market may be due for a pullback or reversal at any moment. Additionally, the indicator shows that price has traded above two highs of the overbought area, further confirming that the market is extended and could be ripe for a downward move. The final piece of the puzzle is the bearish rejection candlestick that forms after these conditions are met. This candle acts as our confirmation signal, indicating that buyers are losing momentum and sellers are stepping in. With all these factors aligned, we enter the trade on the close of the rejection candle, placing our stop loss above the high of the rejection candle. For our take profit, we target the previous swing low, which provides a logical and measured exit point. Now, we wait to see how the trade unfolds. In this case, the market moves in our favor, and the trade successfully hits our take profit level, locking in a solid win. As we are near the end of this video, let's walk through one final example to solidify everything we've covered. This setup is similar to the previous ones, but with a slight variation. We have two swings into the overbought area on the indicator, followed by some internal swings. These internal swings are not counted because, in most cases, they occur during market consolidation and don't provide reliable signals. On the chart, we can also see the previous swing low, which will serve as our take profit target. Additionally, price is clearly in the overbought zone, and we've identified a bearish rejection candlestick, our confirmation signal to enter the trade. With all these elements in place, we enter the market, placing our stop loss above the high of the rejection candle. This ensures we have a clear risk management plan in case the trade doesn't go our way. Now, we hold the trade and let the market play out. In this case, price moves against us and hits our stop loss. While this trade didn't work out, it's a perfect example of why risk management is crucial. By sticking to our plan, we've protected our capital and lived to trade another day. And here's the key takeaway. Even after a loss, we don't deviate from our strategy. We follow the same rules, wait for the next setup, and execute with confidence. This disciplined approach is what separates successful traders from the rest. Even though the market moved against us in the previous trade, we stick to the same rules and avoid making emotional decisions. As we can see, not much has changed on the chart. Price simply moved slightly higher and provided us with another valid signal. This time, we can clearly spot a rejection candlestick, and price remains in the overbought zone, confirming our setup. Additionally, we can observe that price has violated a strong resistance level, which failed to hold. This breakdown of resistance further validates our decision to enter the trade. With this new signal, we have the potential to not only recover the loss from the previous trade but also secure additional profit, as our take profit target has now expanded to the next logical level. We enter the trade and wait for the market to unfold. In this case, price moves in our favor, hitting our take profit and turning the situation around. Traders, This is a perfect example of why sticking to your trading plan is so important. Even after a loss, staying disciplined and following the rules can lead to successful outcomes. And with that, we've reached the end of this video. I hope this strategy, combining the indicator with price action, has given you a clear framework to improve your trading. If you found this helpful, don't forget to like, subscribe, and let me know in the comments what you'd like to see next. Until next time, trade smart and stay consistent.